Welcome to Market Brief After Hours. It has been a highly eventful session across the board. We are seeing a distinct shift to a more cautious tone globally. Wall Street has pulled back from its recent record highs, political drama is weighing heavily on European equities, and there is a lot to unpack regarding the geopolitical situation in the Middle East. Let us dive right in. To start off, Wall Street seemed to take a breather today. What exactly drove the pullback across the major U.S. indices?
It was a classic case of profit-taking. After a spectacular run that pushed markets to fresh intraday records, investors finally decided to take some chips off the table, particularly in the technology and semiconductor sectors. If we look at the numbers, the Dow Jones Industrial Average fell by 0.63% to close at 49,597. The S&P 500 also retreated after briefly touching a new all-time intraday high, ultimately declining 0.38% to finish at 7,337.
And the Nasdaq? That index has been heavily driven by the artificial intelligence boom lately.
Exactly, and it followed a very similar pattern. The Nasdaq Composite touched a fresh record high during the session, but ended up slipping 0.13% to close at 25,806. We saw high-flying names like Amazon, Broadcom, and Micron Technology drag the benchmarks lower. However, it is important to note that this does not look like a panic sell-off. The underlying market sentiment is still quite strong, supported by resilient economic data and robust corporate earnings. People are just locking in gains after a very sharp rally.
That makes sense. Now, shifting gears to the geopolitical side, the energy markets and Treasury yields were quite reactive today. Earlier reports suggested there might be a diplomatic breakthrough between the U.S. and Iran, which initially sent oil prices tumbling, but the reality on the ground seems much more volatile now. And how did that shifting narrative impact the bond market?
As oil prices rebounded and the prospect of ongoing conflict set in, investors immediately started reassessing inflation risks. Any disruption in the Persian Gulf means higher energy costs, which translates to stickier inflation. As a result, U.S. Treasury yields moved higher. The benchmark 10-year yield rose above 4.38%, the 2-year climbed to 3.909%, and the 30-year bond approached 4.97%. The bond market is essentially bracing for the possibility that the Federal Reserve might have to keep interest rates higher for longer if energy-driven inflation returns.
And how did that shifting narrative impact the bond market?
As oil prices rebounded and the prospect of ongoing conflict set in, investors immediately started reassessing inflation risks. Any disruption in the Persian Gulf means higher energy costs, which translates to stickier inflation. As a result, U.S. Treasury yields moved higher. The benchmark 10-year yield rose above 4.38%, the 2-year climbed to 3.909%, and the 30-year bond approached 4.97%. The bond market is essentially bracing for the possibility that the Federal Reserve might have to keep interest rates higher for longer if energy-driven inflation returns.
Let us cross the Atlantic and talk about the United Kingdom. It was a rough day for British equities, and it sounds like politics is the main culprit.
It certainly is. The FTSE 100 suffered one of the sharpest declines in all of Europe, plunging 150 points, or 1.44%, to close at 10,288. The catalyst was the local election results, which pointed to significant losses for Prime Minister Keir Starmer's Labour Party across councils nationwide.
That is quite a shift. This was the first major public test since their general election victory in July 2024, right?
Exactly. Being less than 2 years into their term, these widespread council losses are raising serious red flags about weakening public support. Markets hate political uncertainty, and the prospect of a government losing its political mandate so early on makes investors incredibly nervous. That anxiety bled into the broader European session as well.
How did the rest of the European markets fare in the wake of all this?
It was a sea of red across the continent. Germany's DAX fell 1.02%, France's CAC 40 lost 1.15%, Italy's FTSE MIB declined 0.82%, and Switzerland's SMI dropped 1.11%. We also had some mixed economic data adding to the gloom. On the bright side, Germany's factory orders surged 5% in March, but Eurozone retail sales fell 0.1% for a third consecutive month. Furthermore, France saw its trade deficit widen sharply to 6.9 billion euros, largely due to rising energy imports linked to those very same tensions in the Persian Gulf we discussed earlier. Oh, and Norway's central bank surprised everyone by raising interest rates by 25 basis points to 4.25% to fight off persistent wage and energy inflation.
A lot of moving parts over in Europe. We are going to take a quick break, but when we come back, we will dive deep into the technicals of the Forex and commodities markets and look at the massive individual stock movers of the day. Stay with us. Welcome back to Market Brief After Hours. Before the break, we covered the macro picture. Now, let us get into the weeds with the foreign exchange and commodities markets. For the technical traders out there, let's look at the moving averages, starting with the euro against the dollar. How is that pair holding up?
The Euro-USD pair is actually showing some resilience. It closed at 1.1736, down just 0.10%. It traded in a very narrow range today, but the key takeaway is that it is consolidating above a major support zone. The price is holding above a critical moving average cluster. It is currently sitting above the 50-day simple moving average at 1.1641, the 100-day at 1.1708, and the 200-day at 1.1677. Because it is maintaining higher lows and staying above these averages, the broader recovery structure remains intact despite this consolidation phase.
What about the British pound? With all the political turmoil we just talked about, did the currency take a major hit?
It did pull back, but perhaps not as violently as one might expect given the FTSE's drop. GBP USD closed at 1.3564, down 0.22%. Technically, sterling remains comfortably above its major moving averages. It is sitting above the 50-day simple moving average at 1.3417, the 100-day at 1.3477, and the 200-day at 1.3419. This reinforces a broader bullish technical structure. Today was mostly about moderate profit-taking after a recent rally.
Moving over to Asia, the yen has been a major focal point lately. What is the technical setup for USD JPY right now?
USD JPY remains under pressure. It closed up slightly at 156.86, gaining 0.34% for the session. However, it is still trading below key short-term resistance. It is beneath the 50-day moving average at 158.67 and the 100-day at 157.32. That highlights ongoing short-term weakness. But zooming out, it remains above the 200-day moving average at 154.18, which keeps the medium-term structure looking somewhat constructive. Sellers are definitely defending those rallies into the moving average resistance zones right now.
And how are precious metals reacting to the broader market caution and the rising Treasury yields?
Gold is currently in a consolidation phase. It closed up 0.28% at $4,704. It is stabilizing after a sharp decline from its March peak. Right now, the price is hovering right around the important 100-day moving average at $4,765. It is below the 50-day average of $4,791, but comfortably above the 200-day average at $4,283, so the long-term structure is still intact. Silver, on the other hand, had a very strong day.
Really? What drove the outperformance in silver?
Buyers stepped back in aggressively. Silver closed at $79.12, up 2.41%. This strong session pushed the metal back above its 50-day moving average at $77.37. Now it is challenging the 100-day resistance near $79.83. It is also well above its 200-day average at $62.91. The momentum conditions for silver have improved significantly after several months of choppy trading.
Excellent breakdown. Finally, let us look at the individual companies making headlines. Who are the big market movers today?
It is always great to see strong guidance, but there were some heavy losers today too, particularly in healthcare.
Unfortunately, yes. Insmed took a massive hit, tumbling more than 23% after forecasting full-year product revenue that fell short of analyst estimates. That triggered a wave of selling across the biotech sector. Zoetis also slid over 21% following a narrow revenue miss. And outside of healthcare, Whirlpool declined more than 11% after cutting its full-year revenue guidance due to weaker-than-expected sales.
It sounds like a market that is heavily rewarding strong forward guidance and severely punishing any signs of weakness. Looking ahead, all eyes are going to be on the U.S. labor market. What are we expecting?
Today's initial jobless claims data showed a resilient labor market. Claims rose slightly by 10,000 to 200,000, which was actually below the expected 205,000. Continuing claims also declined. This sets the stage for Friday's highly anticipated non-farm payrolls report. Economists are forecasting that job growth slowed to 62,000 in April, down from 178,000 previously, with the unemployment rate expected to hold steady around 4.3%. How the market reacts to that data will likely dictate the tone for next week.
It is going to be a crucial data point, especially with the Fed watching closely. Thank you for that incredibly detailed breakdown of today's complex market dynamics. And thank you to everyone tuning in. If you find this useful, please follow Market Brief After Hours. See you next time.